All right, so this is business 483 with the Brentwood Associates exiting Zoe's kitchen case analysis. Let me go back to the discussion prompts. Okay, so first it asks us to put ourselves in the shoes of Brentwood Associates management and decide whether or not you will exit Zoe's kitchen now, and if so, what the best option is. So it asks us to vote of what exit plan they should take. So the options are do the initial public offering now, sell to a strategic buyer or financial buyer, or wait and grow the business until it is more valuable before exiting. Austin, you want to go first with your decision?
Yeah, no problem. So this is a tough one for me, and honestly, I think anything that they do would be okay. I think any decision will benefit the company in the end. There's advantages and disadvantages to each one. I personally, I would do the IPO now, and the reason for that, or I guess we're just voting, huh? So I'm going to go IPO, and then we'll discuss it later, I guess.
Yeah, that sounds good. Herb, do you want to go next?
Yeah, I would go either going back to the bank and raising some more money, or making a partial sale to a financial investor, give a minority stake in the company, but raise some additional funds to finance their growth.
Okay. I went back and forth a lot too on mine, and I ended up deciding on that they should wait and grow the business and then do an IPO. But I was kind of on the same page with you, Herb, that because I know they need capital now, and they said they were confident that they could get it from a bank, but it just seems kind of risky to me. So I kind of was thinking the same route as you, Herb, that they should maybe possibly sell a portion to a financial sponsor and then exit later. I guess Herb and I both kind of gave our reasons too. So, Austin, can you go ahead and give your reasoning for your?
Yeah, no problem. So basically, I think that the business is, since it's growing so quickly, I believe that, there was some concern whether or not they'd be able to withstand the scrutiny that comes when you make a company public. I actually worked at Noodles and Company at the time that it was going public. So it was one of the businesses that was also started by this. And Noodles and Company did fairly well. And I know that they were also talking about how Zoe's Kitchen was a lot stronger on the numbers and the growth than Noodles and Company was. And so that's one reason. The other reason is I think they need that capital to grow. And I think that's the best way for them to raise capital at this time. Even though selling off a part of the business is it's a very viable option. I feel like the capital that they could raise through doing that initial public offering would be better for the company.
Yeah, and that makes a lot of sense. And as I thought about it as well, I think I made a mistake because I know I was looking at it from the shoes of Brentwood Associates, but in reality, I think their business model is to purchase a company, grow it, and get out of it, And I think it said in the case study that they typically only spent around 4, 5, 6 years with a company before they sold it, which is about how long they've been with Zoe's. And I recognize that they could, like you said, Austin, they could gain a lot of traction if they raise those funds now. And for me personally, I think the initial public offering could really boost the public knowledge of it, because I had never heard of Zoe's Kitchen before.
Neither have I.
So, I mean, maybe that, but I've heard of Noodles and Company, and I've heard of these other ones. So I think it may be from Brentwood Associates' standpoint, if they truly just want to exit and make a profit, but they don't care necessarily that the profit's huge. Because I think that they want to make a good profit, but I don't think they're in it like a personal business owner to grow it as big as it can go and then get out, if that makes sense. From their past, I think that they've grown companies to an adequate amount to where people can get a good return, and then they hand it over to someone else. So that's a good point you brought up, Austin, because I hadn't really thought about that in that light. Let's see. Do you have anything you want to add, Herb?
Yeah, there actually is a Zoe's Kitchen here in Peachtree City, and it's a little bit on the pricier side than your typical fast food place, but it's still cheaper than your regular sit down restaurant. So I think Zoe's, just like Noodle Kitchen, they have a unique niche market, and I think compared to noodles, they're able to take advantage of that craze for Mediterranean food that's healthier for you. It's more natural. It has less preservatives. There's a fresher taste. It's a new taste in the U.S. restaurant scene. So looking over Exhibit 7, the financials from Noodles, Chai's, and Zoe's, what I noticed is that Zoe's has a dramatically higher year-over-year growth per store, right? So it looks like it's at minimum, I would say it's about twice as much as these competing restaurant chains. But where they still fall flat is two things. One, the volume in sales they do per unit, and then compared to Chai's, which I've never heard of them, so I don't know what they serve, and if that's a fast casual restaurant or not. And then in the number of restaurants in operation, they are a third of what Noodles does. So that's why I think an IPO is still a little early. I'm not saying it should be completely off the table, but I think they have at least another 1 or 2 levels that they can grow Zoe's. In addition, they're really just in the South, right? I think Texas was as far west as they had gotten.
They hadn't expanded a lot geographically yet.
Yeah, so I think California, and then up the East Coast, actually both West Coast and East Coast, there's still a lot of potential for growth and really racking those numbers up quickly, but they just need additional capital to finance that. The other concern I have is that the way that they had changed what was it called? All the pictures, their decor and their menu and the restaurants. Somewhere it said, I think prior to these changes, they had to make $800,000 in revenue to be on the path to profitability per unit, and now it's 1.1 million. So that's 40% increase in revenue that they have to bring in per unit. So again, I just think there's more room for them to expand and make Zoe's a healthier company, and then ask a premium either if they do a private sale or if they go the IPO route.
Yeah, and I think they're at this point, I feel like, kind of like you said, Herb, that they could do an IPO, but they'd be better off to do that later on. And the analyst that came in and discussed whether an IPO was really an option for them said that they had things to work on, but technically they could do it.
Right.
And I think that an IPO is a pretty big deal, and if you don't get that right, there's not a whole lot of future for your company. It's not something you want to mess up, because it'll ruin your market share if you do. So I feel like they should be very careful about this decision, in that, one, the IPO takes a lot more effort and a lot more time to do. And there's a lot more risk involved. But there's also, anytime there's more risk, there's typically a higher potential reward, you know?
Right.
There's merits to each one, and I feel you guys, because I've been stuck in between on them. I've kind of gone that they need to do it, and then that they need to do it, but they need to do it in a few years. But let's move on to this next question, because I feel like we've all stated our positions. So it says, why does Brentwood want to exit now? I can start that. I think that, for one, kind of as I mentioned earlier, Brentwood is in the business of purchasing companies and then growing them and then leaving them. And just with their experience, because I believe they had to hire a new CEO and a board of directors and everything or some management, professional management, to really run Zoe's Kitchen. And I feel like their expertise really is in the growth. And I don't think they like to stay with companies long term because they don't have the emotional attachment that a typical business owner has when they've built a company themselves. So they're looking mostly at growth, how they can achieve that growth, and when a good time is to exit. And typically they've stayed around 4, 5, 6 years. And I think that just shows that they're not in it for the long term of the company as much as they're in it for that first starting a little bit to be their private equity, getting control of the company and getting it to where they want to be. But I just don't see them as long-term owners of a business. So I think that that's probably one of their main reasons for wanting to exit, because it's not what they do, you know. They're not business runners as much as they are developers, if that makes sense.
Yeah, I totally agree with that. I think, that is their business, just to make those sales and to have profitable exits in a relatively short amount of time. And I think even at the beginning, I think it was saying that this would really be, if they were to do the IPO, it would be a home run for them. It would show that they could not only do it once with noodles, but they could do it again. And so it would kind of solidify their credibility as a company if they could do that. So that's why I think a lot of them want to do this now, want to do the IPO now instead of waiting and letting the company grow a little bit more before doing this. Just those two reasons.
I just think there's more room for growth. I mean, if you look over the portfolio companies, I mean, some of them they held on to as long as 6 to 8 years. I wish they would have given us more information on those portfolio companies in regards to how much did they pay for them, what was sales at that time, and how much did they sell them for, and how much was sales and penetration at that time. So you can kind of have a blueprint as to when Brentwood likes to flip their investment and get out of it. So certainly they want to give their shareholders value for their money. I just think with the current returns and the growth, there's more room to capture more market share and make Zoe's a household name. I mean, neither one of you have ever heard of the company, and by now I want to say I can't remember if I saw it somewhat in this case study or not, how many branches or how many locations they have now, but they certainly have grown since then. So again, I just think if they held on for another 2-3 years, they could drastically increase their returns.
Yeah, that makes a lot of sense. That's really what the next question was what are some reasons for holding on now? And I think you really hit on it, Herb, that they have a lot of improvement, and if they did an IPO later, it could really be a home run, grow while they can without the risk of an IPO now. So yeah, and I went that direction. Like I said, I've gone back and forth, which it's this one's been hard for me because I see really legitimate merits with both options. Um, and I honestly I haven't been able to stick with one real solidly. So
Well, and
let's
you always have to remember, if you do an IPO, unless Brentwood just wants to do an IPO and get out of it. But once you do an IPO, you give up a lot of control, and you have to open your books a lot more. You have to give the public a lot of information that you don't have to share with anybody if you're a privately held company.
right, and that's going to cost them a lot of money too. And I think the current CEO is worried about that too because he doesn't have the expertise to deal with a ton of different investors. You know, he has the few now that he can deal with, but I felt like the company still needs to grow in terms of management before they go to an IPO. And I think that if they tried to do it now, the IPO progress it'd be rushed, and they'd get into it, and they wouldn't be fully prepared for following the IPO, like you said, Herb. That it takes a lot more responsibility after that because you're now you answered all the shareholders.
Yeah.
And like you said, now you have to trade or show your financials every quarter. And another thing they mentioned, when you have to show your financials every quarter, it kind of can skew things because, you know, maybe you're looking at the end of year, and in order to meet your goals for the end of the year, you spend more in one quarter, which can look bad if you don't really understand. And if you don't have that good communication with your investors, a lot can pull out then because if they're just looking at the financials. So I feel like there's a lot of risk in that section if they're not fully prepared financially to show those numbers and to lead their investors. I think that's the biggest concern for me about the IPO. I just don't feel like the management's ready to take over what happens after an IPO goes through.
Yeah.
Yeah, there are definitely some good reasons for holding. There definitely is a lot of potential for growth, and I'm not quite sure why they haven't expanded to the west. I know where I'm from in Colorado, there's tons of those type of restaurants, and they make a lot of money. But perhaps I don't know. Perhaps they're worried about cannibalization. I don't know, but I think another reason for holding besides just growth is just like you were saying, Herb, is kind of to make it become a household name. So I guess if they were to hold on, there would be a lot of benefit to it. They'd probably get a lot more out of the IPO. So there's definitely some validity to holding instead of doing the IPO.
Yeah.
Yeah, and really, I mean, it depends on who Brentwood and what's the guy's name? Aga something or whatever.
Yeah, I don't know how to pronounce it.
Who they want to be. And just from reading over those portfolio companies, it looked like they wanted to take it to a certain level and then, reap the profit. So the question really is, do they feel confident that they've already taken Zoe to that solid level, or do they feel that there's still room for short-term growth? They shouldn't hold on to it for another 10 years to make it a household name, right? But if another 2 years can increase their market share, if they can go from, what are they, 102 restaurants, so they've grown about 25 restaurants every year. So if they can accelerate that, and within another 2 years, if they can add, 80, 100 restaurants, I'd say hold on. But if they've kind of peaked in regards to growth, they should do an IPO and get out of it.
Yeah, that makes a lot of sense. Let's see, we've discussed this quite a bit, but so it says what can go right under each scenario and what can go wrong. Do you guys have anything else to add for what can go right and what could go wrong under the scenarios?
Well, I guess if they hold on to it for a bit longer, they can definitely grow their grow the numbers for the IPO, get more money out of it. What can go wrong? They can. I feel sometimes if they were to hold on to the company too long, until it had, I don't know, because the growth of new companies slows down after a while. In the beginning, there's some pretty explosive growth. So if they were to hold on for too long, to where the growth started to diminish, that could not look as good. It could look like the company wasn't doing as good as it was before, so that it could be lower on the IPO. If they're doing the IPO, they can get a lot of money out of it. They can have that home run situation. They can also put the company under undue financial stress, and have it kind of scrutinized by a bunch of people, which could make or break it. So they could definitely break the company if they do the IPO right now.
Yeah, and one point that Austin made that gave me pause for thought is, he said that in his local market in Colorado, there's a lot of these kind of restaurants that are a little healthier, a little bit more vegetarian. So maybe that's the reason that they have not expanded to the West Coast and up the East Coast, because there's already a lot of these kinds of restaurants in the market. And maybe their niche is kind of being in the South and being kind of the front runner in that fast casual healthy food category. So again, I think it comes down to how much potential they see over the next 18 to 24 months.
Right. Yeah, and I think that's an interesting thing because I'm not sure that they've taken that into account. The forecast that I looked at in the case, it seemed like they were just basing it off of past experience, but that's a really interesting thing to think about, because the South, like, we don't have all these healthy foods. You know what it's like, Herb. There's a lot of fried food, fried chicken places. So it is a niche here. Yeah, that's something that definitely should be taken into account as they look at their future growth. But when I look at their forecast, I don't know that that's been taken into account or not. They seem to have fairly high forecasts. It seems like they expect it to grow quite a bit in the next year or so. If that continues, then I would say holding on and then doing an IPO later. But like you said, Austin, that if they wait and their market share goes down, then they're going to be worse off with an IPO then as well, and with every other deal. Let's see. So the next question is, let me get back to it. Okay, so how much is Zoe's worth under each exit option? So I think I got this wrong on how I calculated it, but
I'm right with you.
for the strategic investors, I got that it was worth 143 million. The financial sponsor, I got that it was worth 88 million, and the IPO around 230 million.
Yep, that's pretty much what I got. I mean, I just went straight to the text. It said financial sponsor and strategic investor between 8 to 13 times, and then IPOs 21 times. With their earnings before income tax, and I think the last earning on Exhibit 7 was right at 11 million. So I think you're pretty much on the money with your calculations.
I was also pretty similar. For the IPO, I got something. I got a little higher. I got around 160 million. But I don't know. I did it the way that I learned it in another. I don't know. I don't know. I did it with,
You're probably more accurate then.
I'm not sure according to this. I'm sure your guys' calculations according to this class are solid. So we'll just go with those.
Well, I think we all agree that.
Yeah, and Landon, I think you said 230 million for the IPO, right?
Oh, so yeah, 230 million.
Yeah.
Oh, never mind then. Never mind.
Yeah, sorry about that. That was,
And I had 217 million, so we're both right there.
Well, sounds good.
all right. And okay, yeah. So then it says, what differences do you observe based on the valuation and who buys the company, and does this make any sense? So for me, going back to kind of the risks slash rewards, IPO is the riskiest. And plus, it's kind of like almost a crowdfunding where people can just come in and buy as much as they want, you know.
Yeah.
So I think that makes sense that it's the highest, the IPO. The strategic investor, I had it as second, and that makes sense to me because they're going to come in, either make partnerships, join in conglomerates, and be able to add their brand name to it. Whereas the financial sponsor is only going to come in and take a portion of it. And they don't bring in a lot of value as far as business. They just bring financial value, which is why I said that they were the lowest amount. What were your reasons?
So what is the difference between a financial and a strategic investor? I didn't quite, to me, they sounded very similar.
Let's see. I thought that the strategic finance guy was someone that could come in and deal with partnerships, and bring it into like another conglomerate company. Whereas let's see, what was the other one?
Financial. So the financial is really just what Brentwood is, but just with deeper pockets.
Basically, yeah, where a financial sponsor is just bringing equity, but they don't. I think Brentwood took 100% equity, whereas the financial sponsor only took a smaller portion of the equity. And that's how I understood it, but I could definitely be wrong. Do you guys have any other thoughts on that?
No, mine was pretty similar. I don't know. I think it would actually be, and this might not be as correct, but I think just as to the Brentwood itself, I was thinking if they do not get some sort of cash influx, that it might be riskier to them as far as they go, not because they might not be able to grow as quickly, and it might show that they're kind of going downhill. But otherwise, I'm right in line with Landon.
I think that's a good point. Because that's what they focus on, making a return on their investment, and if they don't capture it when they can, then that's another good reason for them to not hold out. Okay, so let's see. That all makes sense to us. So the next question, the final question actually, why would anyone sell to a financial buyer instead of an IPO? And I mean, we've covered that pretty well. There's a lot of risk in an IPO. You have to take on the public accounting practices. You have to be accountable to a lot more shareholders. You have to hold board meetings and things like that. And really, it just increases the management and overhead expenses for your company. The benefits of that are you can bring in a lot of capital and a lot of awareness of your product. A strategic investor, though, they can bring in, I think it said in the case study that one example of a strategic investor brought in 20 times a multiple of 20, which is barely less than an IPO, and they don't bring nearly as much risk.
Yeah.
And they don't bring as much work. It's something that kind of happens instantly, you know. So if you have a company that's valued high already and you have an offer that's already nearly the amount of a probable IPO, then it would make sense to just go with a strategic investor, because then you're done, you're out, and you don't have to plan for the future in terms of your new responsibilities as a publicly traded company.
And then the other, if you sell to a financial investor, you don't have to open your books to the public. With an IPO, even though they mentioned this one new, what is it, PAPS or whatever it was called, This new form of going public,
Yeah, I'm trying to just remember what it was.
whatever abbreviation it was. That makes it still kind of a little bit under the table and private, but you still have to open yourself to the SEC and to all the expenses that come with it. So even though you don't have to open your books, you still are spending that money. So with a financial investor, it's a lot easier. It's less expensive. And probably, since you don't have to open your books to anybody else except the interested parties, that should allow you, if you have such a solid company, it should allow you to ask for a higher buying price, because you can say, hey, you can tell this company is on the right track. You can tell that this company still has a lot of room for growth. So if you buy it at this asking price, even though it's a higher valuation than typical, because there's still room enough for growth, when you then initiate an IPO, you as the buyer will be able to sell it and still make oodles of money.
Yeah, I totally agree with that. I think you guys covered it. I mean, it is pretty risky to do the IPO. A lot of different things you need to put in place when you do that. Just like you guys talked about, you need to do the GAAP accounting and need to do those reports that sometimes people can misunderstand. But I think it is pretty thoroughly covered.
Yeah, I agree. That's an interesting point you brought up, Herb, that if they don't take any deals now, the further they go into it, really their only option is going to be an IPO in the future, because an investor is looking for a company that has growth left in it, and if it settles out in the future, then it really brings their options down. That's a really good point, and I'm glad you brought that up, Herb. All right, yeah, I feel like we had a good discussion. Does anyone have any final comments that they want to add before I stop the broadcast?
No, just thank you so much. You're going to make my case study a little bit more lively, because you both make very good points that kind of open my eyes to some of these other options.
I know it's kind of nice having a group that helps you with the work.
Right, and has diverse viewpoints. So, thanks.
Good deal. All right, I'll go ahead and stop the broadcast then.